Hey everyone, welcome back for this deep dive. We always try to tailor these deep dives to what you guys want to learn about, and um, lately we've been getting a ton of questions about the whole idea of market predictions,
Yeah, it's definitely a hot topic.
to say the least, right? So that's what we're digging into today. Can we really predict the market using these quantitative finance models, these QF models, if the market's always adapting and reacting to itself?
It's a question that's plagued, well, not plagued maybe, but it's a question a lot of people have been thinking about.
For sure, for years. And you sent over this paper, Epistemic Limits of Empirical Finance. Now, I'll admit, that title's a mouthful.
Haha. Yeah, academia's got its own language sometimes.
It really does. But don't worry, we've broken it down for you. Essentially, it digs into this idea that everyone's searching for, like, the holy grail of finance, that one formula or indicator that unlocks market predictions, this causal investing.
Oh, absolutely. Everyone wants that crystal ball, right?
Right. But the paper argues that while understanding cause and effect is super important, assuming it always works in one direction might be a little simplistic when we're talking about the crazy world of finance.
Yeah, it's definitely not as simple as saying this company had great earnings, so their stock will go up, though we wish it was.
Definitely. So it's not that straightforward.
Nope. The paper uses this example. What if a huge, unexpected stock price move actually changes how the news about that company gets reported or how analysts interpret it? So suddenly, the effect, the price move, becomes the cause, shaping the very factors we thought were driving it in the first place.
Whoa, so it's like the market's reacting to its own reflection in a way? And by reacting, it's changing the reflection, which then changes how it reacts again.
Exactly. It's this constant feedback loop.
Okay, I'm starting to see why this is more complex than it seems.
And here's why it matters to you. Relying only on these simple past relationships, just assuming things will keep happening the same way, that can lead to, well, let's just say some unpleasant surprises.
Because the market loves to throw curveballs.
That's one way to put it. What might seem like a solid pattern from the past can quickly become a trap as the market, it adapts, it's alive.
And this is where the paper gets really interesting. It brings in this whole idea of, get this, an ecological model to explain how this reflexivity thing works in markets.
Yeah, it's actually a pretty cool way to think about it. Helps you see why just looking at things in a straight line, A to B, doesn't always cut it.
Definitely. So, like, what do ecosystems have to do with Wall Street? Give us the rundown.
Okay, so picture this.
Yeah.
You've got your classic predator-prey situation, right? Like foxes and rabbits. More rabbits, well, that usually means more foxes, at least for a while. More food, more foxes, makes sense. But then, and this is key, all those foxes mean there are fewer rabbits around eventually, right? They get eaten, so their numbers drop, and then boom, less food for the foxes, so their population takes a hit too. It's a cycle, this constant back and forth, not just a simple, this happens, so this other thing always happens.
Okay, so I'm seeing the parallel here. Investors, they're not just reacting to, like, company earnings reports or whatever. They're watching each other, trying to anticipate the next move.
You got it. Think of the market as that ecosystem. Only instead of foxes and rabbits, we've got all these different players, different species, if you will, day traders, big institutions, hedge funds, even those algorithms everyone talks about. They're all tangled up together, reacting not just to the news, but to each other, trying to stay one step ahead. Creates these crazy feedback loops.
So what might have seemed like a sure thing, a strategy based on past data, could just, I don't know, go haywire because the system changes the rules as it goes.
That's the gist of it, yeah. The paper, it even calls out back testing, when you test a trading strategy on historical data, says that can be really misleading because you're basically assuming the market's going to behave the same way it did in the past.
And that's rarely the case, right?
Exactly. The authors use this metaphor. They say it's like trying to navigate through a jungle with an old, outdated map. The terrain might look familiar, but things have shifted, paths have changed. What used to be a clear route to a destination could lead you straight into a swamp now.
Ouch. Okay, so how do we avoid getting stuck in that swamp? If everything's always changing, how can anyone make smart decisions, especially in the market? So after that analogy, I got to ask, does this mean we should just ditch all the fancy models, all the quantitative analysis stuff? I mean, it can't be that simple, can it?
You're right. It's not about throwing the baby out with the bathwater. We're not saying quantitative finance is useless, not at all. It's about using it smarter, being more aware of its limitations.
Okay, so nuance is key. What are some practical takeaways for our listeners? Things they can actually use to deal with this whole reflexivity thing when they're looking at markets.
The paper really stresses this point. Just because a model fits past data perfectly, amazingly well even, doesn't mean it's uncovered some fundamental truth about how markets work. It might just be picking up on patterns that were temporary or even biases baked in by the people who built it. Remember all those different species we talked about, each with their own way of seeing the market? Well, those viewpoints, they get embedded in the models.
Right, makes sense. Just because something worked before doesn't mean it's a guarantee for the future. What else?
This might sound counterintuitive, but embrace the uncertainty. Accept that markets are going to surprise us. They always have. They're driven by human behavior, by all these connections. It's messy. Instead of chasing these impossible guarantees, focus on what you can control, and that's managing your risk. Know how much you're comfortable losing, really understand your risk tolerance, and build your whole approach around that.
Solid advice. So to wrap up this deep dive, we've learned that markets, they're reflexive. They don't play by simple cause and effect rules. And thinking they do can lead to, well, some bad decisions.
Exactly. And that brings us to a final thought for you to ponder. If financial markets are more about these narratives, about perceptions that are constantly in flux, how does that change how you invest? How does it change how you even interpret financial news? Something to think about.
Definitely a lot to chew on. And as always, this deep dive was made just for you, so any questions at all, don't hesitate to reach out. Until next time, happy investing.